NFI Group just reported their Q2 2026 numbers, and here is the immediate headline. Revenue came in at $1.03 billion.
Right.
That is an 18.6% year-over-year increase, beating the $965.79 million consensus by 6.65%.
Huge top-line beat.
Yeah, but adjusted EPS was 23 cents, so that was a miss, falling short by roughly 0.4 of a cent against the 23.43-cent estimate.
Very narrow miss, though.
Exactly, and management completely brushed it off and raised full-year 2026 guidance. They're projecting revenue between 4.0 and 4.2 billion Canadian, and adjusted EBITDA between 385 and 415 million.
And the market loved it.
The stock jumped 2.98% to $25.60, trading right near its 52-week high. So our mission for this deep dive is to synthesize the earnings transcript, the updated balance sheet, and analyst notes to figure out, if this operational turnaround is actually structurally sound.
Right, or if NFI is just like riding a temporary wave here.
Exactly. So let's start with that EPS miss. The market completely ignored it. Why?
Well, the market ignored that fractional miss because the underlying cash generation tells just a way more compelling story. I mean, look past the headline revenue. The net earnings swung from a $160.8 million loss in this exact quarter last year.
Which is massive.
Right, massive bleed. And they swung it to a $17.4 million profit today.
Wow. Okay, so a complete 180.
Exactly. Furthermore, adjusted EBITDA jumped 47% year over year to $104 million.
And that metric is crucial, right? Because it strips out all the accounting noise.
Yeah, it shows that the core operations are actually capturing real cash now. They aren't just moving inventory around at a loss anymore.
Okay, so selling more buses is one thing, but to understand a revenue beat of nearly $64 million, we really need to dissect where the actual margin is expanding.
Right, you have to look under the hood.
Yeah, and NFI basically splits its business into core manufacturing, building the actual buses, and the aftermarket segment, which handles parts and maintenance.
Then that split is everything.
So if you're looking at this business model, think of it like a movie theater.
Okay, I like that.
The manufacturing segment, that's your ticket sales, right? Selling a $500,000 transit bus gets the customer in the door and covers the heavy fixed overhead.
But historically, the profit margins on the vehicles themselves are just notoriously thin.
Exactly. So the aftermarket segment, on the other hand, is the popcorn and soda.
Right, the concessions.
Servicing that bus with proprietary parts over its 20-year lifespan, that is where the high-margin cash is printed.
And this quarter, that aftermarket division posted a record 31.4% gross margin.
Up from 26.4%, which is a massive jump.
It is. But diving into the management commentary, that specific figure looks like a temporary sugar high.
Wait, really? A sugar high?
Yeah, it's a near-term peak, and management is actually openly broadcasting that.
So what was the catalyst then?
Aggressive preparation for the upcoming FIFA World Cup.
Oh, interesting.
Right. When a globally televised mega event hits North American host cities like, Los Angeles, Toronto, or Mexico City, transit agencies face just immense pressure.
Yeah, you cannot afford to have a bus break down on the highway when it's carrying thousands of international fans.
Exactly. So municipalities have been preemptively stockpiling replacement parts and just rushing heavy preventative maintenance.
Got it. So that creates a massive pull forward of demand.
Exactly. And management fully expects aftermarket revenue to normalize in the second half of 2026.
Because that wave of preventative spending subsides, and agencies just return to their standard schedules.
You got it.
Okay, so a temporary spike in part sales makes sense. But the structural turnaround seems to be happening on the manufacturing side. Right?
Yeah, that's the real story here.
Because manufacturing gross margins improved to 11.5%, up from 10.6%.
Right. And in the context of heavy industrial manufacturing, expanding your margin by 90 basis points on $1 billion of revenue.
It actually moves the needle significantly.
It absolutely does.
So what levers did they pull to achieve that 11.5%?
Mostly volume and inventory velocity. So first, NFI delivered 22% more North American transit buses compared to last year.
Okay, so just pushing more metal out the door.
Yeah, but the critical mechanism behind the margin expansion was the successful unwinding of work-in-process inventory, or WIP, that they carried over from the first quarter.
Okay, let's break down the mechanics of that WIP unwinding. Because for anyone analyzing this, it really illustrates the fragility of this business over the last 3 years.
Yeah, it's been a tough run.
So a work-in-process bus is essentially a $1 million piece of trapped capital.
Right.
You have this vehicle sitting on the factory floor that is like 99% finished. It's absorbed thousands of hours of union labor, Super expensive steel, a massive battery pack.
Yeah.
But because it is missing, say, a single legacy seating component or a specific wiring harness due to some supply chain bottleneck,
Hmm.
you just cannot ship it.
And if you cannot ship it, the transit agency doesn't sign the final acceptance paperwork.
Right, which means NFI cannot issue the invoice, so the cash is literally just parked on the lot.
Exactly. So what changed in Q2 is that those specific supply chain bottlenecks finally cleared up.
Oh.
Yeah, NFI received those missing seating components, finished the legacy buses, and pushed them out the door.
And the moment those units flow out, the factory achieves much better fixed cost absorption, right?
Yes, because the baseline costs of operating a massive manufacturing footprint like property taxes, facility electricity, management salaries, insurance.
All of that is now spread across a significantly larger number of invoiced, paid-for buses.
Exactly. That efficiency is the direct driver of the margin ticking up to that 11.5%.
Okay, so unwinding that trapped WIP directly fueled a massive swing in liquidity, pulling operating cash flow into positive territory at $159.1 million.
Which is huge for them.
It is, but this is where the bullish narrative meets cold reality.
Uh-oh, here we go.
Generating $159 million in a quarter is fantastic, but NFI is carrying a trailing debt-to-equity ratio of 221.05.
Yeah, that is a big number.
I mean, that is a staggering mountain of leverage hanging over the equity. So I have to ask, is this quarter's cash generation actually structurally repairing the balance sheet, or are they just, paying the interest on the credit card?
Well, the absolute debt load is heavy, yes. It's a lingering hangover from the pandemic supply chain crisis.
Right.
However, the trajectory is moving rapidly in the right direction. Because of that $159 million in cash flow, their total leverage ratio, which is total debt measured against adjusted EBITDA, dropped to 2.81 times.
Okay, 2.81. What's the target?
Management's stated target is to compress that ratio down to between 1.5 and 2.5 times by 2027.
Got it. So at 2.81, they are actually within striking distance of that.
They are, but the real story, honestly, is how they deployed that new cash alongside some really strategic refinancing right after the quarter closed.
Yeah, the debt restructuring moves in July were highly calculated.
Very.
They completed a private placement of 350 million Canadian in senior unsecured notes at 6.625%. And then they took that fresh capital and immediately paid off a $50 million loan from the Manitoba government, which was carrying a much heavier 7% interest rate.
Yep, smart move.
And they also took a massive chunk out of their first lend facility, effectively extending its maturity out to July 2030.
And paying down that first lien facility is really the linchpin of this entire financial maneuver.
How so?
Well, first lien debt is senior secured debt, right? It sits at the very top of the capital structure, and it typically restricts the company's collateral heavily.
Okay, right.
By clearing out a large portion of that restrictive debt with unsecured notes, NFI freed up substantial borrowing capacity.
And they needed that flexibility to address that $338 million convertible debenture maturity looming in January 2027.
Exactly.
Because a convertible debenture can be an absolute ticking time bomb for shareholders if the stock price is depressed when it matures.
Right. It forces painful dilution.
Exactly. So by refinancing the expensive provincial loan, pushing out the secured facility to 2030, and just hoarding that operating cash, they have amassed $520 million in total liquidity.
Which essentially neutralizes that 2027 debenture maturity entirely.
It transforms it from an existential threat that could have, triggered restructuring into just a scheduled cash payment they're fully capitalized to make.
Boom. The balance sheet is stabilized.
Wow. Okay.
Yeah, they have basically bought themselves the financial runway to operate without the constant threat of a liquidity crisis hanging over their heads.
But financial engineering doesn't secure future earnings.
True.
To see if this momentum is sustainable, we have to evaluate management's confidence in their forward visibility. And CEO John Sapp stated on the earnings call that NFI is officially moving past the recovery phase and into a period of stable execution.
Yeah, he sounded very confident.
And the evidence he provided is their massive $12.5 billion backlog,
which is a staggering pipeline.
It translates to 14,483 equivalent units. And for anyone holding this stock, a $12.5 billion pipeline sounds like a guaranteed safety net.
It does sound great on paper.
But the structure of that backlog dictates how reliable it actually is. So out of those 14,483 units, only 6,271 are firm orders.
Right.
Those are signed contracts with allocated municipal funding.
The real deal.
Exactly.
Yeah.
The remaining 8,212 units are options.
And an option just means a transit agency has reserved the right, or basically their place in line, to buy buses at a pre-negotiated price at some future date.
It is not a binding purchase agreement until they exercise it.
Correct. But while options are technically non-binding, NFI boasts a historically high conversion rate on them.
Really? Why are they so reliable?
It comes down to the underlying macro environment basically forcing municipalities' hands. The North American transit fleet is just aging past its useful life.
Okay, give me the numbers on that.
So the average age of a transit bus in the United States is currently 8.2 years. In Canada, it is 10.4 years.
Wow, over a decade for a city bus.
Right, and these are heavy-duty workhorses driven constantly in grueling urban environments. Potholes, traffic, weather.
Yeah, that takes a toll.
Exactly. So once a transit bus pushes past that 8 to 10-year mark, the daily maintenance costs just begin to cannibalize the city's entire transit budget.
They literally break down too often to keep fixing.
Right. The municipalities have no choice but to recapitalize their fleets. They cannot simply opt out of providing public transportation to their citizens.
But municipal budgets are chronically stretched, right?
Yeah.
Local governments rarely have the discretionary cash to replace entire fleets of million-dollar vehicles on a whim,
No, definitely not.
which means they rely almost entirely on federal subsidies.
Yes, heavily.
And the current U.S. infrastructure bill, which is subsidizing a massive portion of this exact backlog, matures in September 2026.
It does.
If that federal faucet gets turned off, those 8,212 options could just evaporate.
The political risk is real, absolutely. But the policy environment actually offers strong visibility right now.
Okay, how so?
The pending Build America 250 Act is currently moving through the legislative process, and management really emphasized its broad bipartisan support.
Bipartisan. That's rare these days.
Well, local transit infrastructure, whether you're in a red state or a blue state, is a shared priority because it directly impacts local employment and local commerce.
Right, people need to get to work.
Exactly. So industry consensus is that federal funding for fleet recapitalization will continue.
Even if things get delayed.
Yeah, even if the new legislation gets stalled past that September 2026 deadline, there is deep historical precedent in Washington for passing temporary funding extensions just to keep infrastructure money flowing.
Okay, that makes sense.
Because of this structural demand and the funding confidence, management expects this backlog to secure NFI's production schedule deep into 2028.
Okay, so the demand side looks robust and the balance sheet is fixed. But NFI is still navigating immediate structural and seasonal headwinds that threaten to compress their margins in the back half of this year.
Yeah, it's not all clear skies just yet.
Let's look at the trailing 12-month gross margin. Despite the really impressive second quarter, their 12-month margin sits at a very thin 9.16%.
Pretty tight.
And Q3 is setting up to be a classic summer slump.
Yeah. The third quarter deceleration is basically driven by unavoidable seasonality. NFI schedules summer vacation shutdowns across its manufacturing facilities, which literally halts production for weeks.
Wow, okay.
Simultaneously, customer acceptance activity slows down.
Because the transit agency officials are on vacation too.
Exactly. They take their own summer holidays, which delays the final physical inspections of the buses.
And if the agency does not inspect and accept the bus, NFI cannot recognize the revenue.
Right, pushing all those deliveries from Q3 right into Q4.
Okay, beyond the summer delays, management explicitly warned about a product mix shift that is going to drag down blended margins in the second half of the year.
Yeah, this is a structural issue.
Right. During the first two quarters, NFI delivered a high concentration of North American transit buses, which we know are highly customized and command premium margins. Yep. But starting in Q3, their delivery mix shifts heavily toward private motor coaches and international transit vehicles.
And that's a very different market.
Completely. Private motor coaches operate in a more fragmented, price-sensitive commercial market without the shield of federal subsidies.
Right, so NFI has to compete a lot harder on price.
Exactly. So even if they produce the exact same number of total vehicles in the second half, the structural shift toward these lower margin products will inevitably weigh on their overall profitability.
And speaking of the international transit market, the situation in the United Kingdom is a major drag on earnings right now.
I saw that. NFI took an $8.9 million restructuring charge in Q2, entirely related to their Alexander Dennis business in the UK.
Yeah, the UK transit market has basically been flooded by intense foreign competition.
What kind of competition?
Manufacturers, primarily from lower-cost regions, are just aggressively pricing zero-emission buses to capture market share. NFI realized that their legacy UK manufacturing footprint was just too bloated and expensive to compete in a literal price war.
So to stop the cash bleed, they are basically executing a painful defensive retreat.
That's a good way to put it.
They are entirely shutting down their manufacturing facility in Falkirk, Scotland.
Right.
And concurrently, they are converting their Larbert facility to operate strictly as a chassis manufacturing plant rather than assembling the fully finished bus.
And the mechanics of this move are purely about overhead reduction.
Just cutting costs.
Right. Because full bus assembly requires massive square footage, high labor hours for interior finishing, painting, electronics integration. It's a lot.
Right. Whereas chassis manufacturing is a much smaller, more streamlined engineering process focused just on the frame and the powertrain.
Exactly. So by shrinking their footprint and reducing that assembly labor, they are attempting to reset their cost structure to basically survive this foreign price war.
But they have to absorb millions in upfront restructuring costs to execute the pivot, obviously.
Yeah, that 8.9 million charge. And
Yeah.
look, the UK restructuring is a localized problem, but NFI is also navigating a highly volatile geopolitical landscape in North America.
Right, specifically regarding tariffs and the supply chain.
Yes. NFI's business model relies on a very complex cross-border manufacturing dance.
Right, they move raw materials, chassis, and finished components back and forth across the U.S.-Canadian border constantly.
Yeah, between their facilities in Winnipeg, Minnesota, and North Dakota, just to comply with Buy America regulations.
And management did note that their upgraded full-year guidance completely bakes in the known 50% U.S. tariffs on Canadian inputs.
They have. They've successfully negotiated pricing adjustments with municipalities to pass some of that tariff cost along.
Which is good.
But they are operating in an incredibly fragile trade environment. The guidance only accounts for the tariffs on the books today.
Right. If sweeping new tariffs are implemented or trade policies shift suddenly, it would immediately compress NFI's margins.
Instantly. They would be forced back to the negotiating table with local transit agencies who, as we discussed, are already maxed out on their budgets.
And tariffs just amplify the underlying physical fragility of the supply chain. I mean, the WIP inventory unwound successfully this quarter, but the ecosystem remains so vulnerable.
Right. If a single critical supplier of axles or battery cells faces a labor strike or a raw material shortage, the buses stop rolling off the assembly line again.
The inventory gets trapped, the fixed cost absorption plummets, and the cash flow just halts.
Yeah. The financial turnaround in Q2 is brilliant, don't get me wrong, but they are walking a tightrope balancing product mix shifts, overseas restructuring, and unpredictable trade policies for the rest of the year.
So the runway is clear, but they have to fly through a storm to hit their 2026 targets.
That's perfectly said.
Which brings us to a final underlying tension woven throughout the analyst notes regarding the zero-emission bus market.
Right, the EV transition.
Yeah, transit agencies are increasingly delaying their scheduled orders for battery-electric zero-emission vehicles.
And to be clear, the delays are not happening because they prefer diesel.
No, the municipal demand for electric fleets is massive.
Right.
They are delaying the orders because their local power grids and depot charging infrastructure simply cannot handle the load of charging 100 heavy-duty electric buses simultaneously.
It's a huge bottleneck.
It is, and this presents a massive variable for NFI's future.
Yeah, it really makes you wonder.
Right. Will this municipal infrastructure bottleneck result in a massive coiled spring of delayed demand that just explodes onto NFI's books in 2027 once the local grids are finally upgraded? Or does this bottleneck leave NFI's $12.5 billion backlog exposed to sudden cancellations if city councils realize they lack the capital and the time to build out their electrical infrastructure?
It is the ultimate bottleneck dictating the pace of municipal transit over the next decade.
It really is. So if you want to stay ahead of how these macro bottlenecks, supply chain shifts, and balance sheet maneuvers impact your portfolio, follow the show for our daily earnings coverage. We will be right back here analyzing the numbers that actually matter.